Your bank might be hiding billions in losses, and you won't find out until it's too late, just like the customers who woke up one morning to find their bank had collapsed overnight. Here's what's happening right now. New York Community Bank, now called Flagstar Financial, just got downgraded to junk status by Moody's. Junk. That means the credit rating agencies think there's a real chance this bank could fail. The stock is down 60% from its peak. They lost $252 million in Q4 for 2023 alone, and they just pushed their profitability target from 2020 to 2026, which is banking code for "we're in serious trouble." But NYCB isn't alone. Wells Fargo's CEO just admitted the bank will lose $2 to $3 billion on commercial real estate loans over the next 3-4 years. JP Morgan has $28 billion in office loan exposure. And here's the scary part. These are the big banks that are supposed to be safe. If they're admitting losses, imagine what the smaller regional banks are hiding. The truth is, we're in banking crisis 2.0. The Silicon Valley Bank and Signature Bank collapses in March 2023 weren't the end of the problem, they were the beginning. Banks learn to hide their losses better. They extend bad loans instead of foreclosing. They pretend everything is fine, until suddenly it isn't. In this video, I'm exposing which banks are at the highest risk of failure, how to check if your bank is on the danger list, why FDIC insurance might not save you, and exactly what you need to do right now to protect your money before the next wave of bank failures hits. But there's one category of bank loans that is by far the most dangerous, and it's hiding in plain sight on every regional bank's balance sheet. It's commercial real estate loans, and the numbers are absolutely terrifying. Let me give you the context. When COVID hit in 2020, interest rates dropped to near zero. Banks were lending money to real estate developers at 3% interest rates. Developers borrowed hundreds of billions to buy office buildings, shopping centers, and apartment complexes. But then inflation hit. The Fed raised interest rates from 0% to 5.5% in less than 2 years, the fastest rate increase in 40 years. And here's the problem. Most commercial real estate loans have terms of 5 to 7 years, which means all those loans made in 2018, 2019, and 2020 are coming due right now. When these loans mature, developers have to refinance at the new higher rates. Instead of 3% interest, they're looking at 7 or 8%. That doubles their debt service costs. And most properties can't generate enough cash flow to cover the higher payments. So what happens? Defaults, foreclosures, losses. Here's the data that should scare you. $957 billion in commercial real estate debt is maturing in 2025 alone. That's nearly $1 trillion. And the special servicing rate for office loans, which measures loans that are in trouble, just hit 16.19%. That's the highest level in 25 years. Higher than 2008. Higher than COVID. Higher than any crisis in a generation. Office buildings are particularly bad. With remote work, office vacancy rates in major cities are 20-30%. In San Francisco, it's over 35%. For buildings that were worth $100 million in 2019 are now worth $40 million. But the loans are still for $80 million. That means banks are holding loans that are worth twice what the underlying collateral is worth. They're massively underwater. And here's where it gets worse. Regional banks are loaded with these loans. According to Federal Reserve data, regional banks have 28.7% of their loan portfolios in commercial real estate. The big banks like JP Morgan and Bank of America, only 6.5%. Regional banks have 4.4 times more exposure than big banks. A study from Florida Atlantic University identified which banks are most at risk. They're finding any bank with a commercial real estate to capital ratio over 300% is at heightened risk of failure, and hundreds of small and mid-sized banks exceed this threshold. Think about what 300% means. If the bank has $1 billion in capital and they have $3 billion or more in commercial real estate loans, they're in the danger zone. If just 15–20% of those loans go bad, the bank becomes insolvent. And remember, these loans are starting to mature now. Throughout 2025, 2026, and 2027, we're going to see wave after wave of refinancing that can't happen at profitable rates. Banks have been playing a game called extend and pretend. Instead of foreclosing on bad loans and taking losses, they extend the loan for another year or two and pretend everything is fine. But you can only kick the can down the road for so long. Barry Sternlicht, the billionaire founder of Starwood Capital, recently predicted that 500 to 1,000 banks will fail in the next 2 years because of commercial real estate losses. Not 5 banks, not 50 banks, 500 to 1,000 banks. This isn't fear-mongering, this is math. But commercial real estate isn't the only toxic loan category destroying banks. This next lending disaster is perhaps the most dangerous because it's growing exponentially and almost nobody is paying attention to it. It's called NDFI loans, non-depository financial institution loans. And there's a massive fraud problem that's just starting to surface. Here's how it works. Traditional banks have become very cautious about lending after 2008. They require extensive documentation, appraisals, income verification, the whole process. So entrepreneurs and real estate investors turn to non-bank lenders, companies that lend money but aren't regulated like traditional banks. These non-bank lenders make quick decisions with minimal paperwork. They charge higher interest rates, often 8–12%, but they fund deals fast. And to get capital, these non-bank lenders go to banks and borrow money. So banks aren't directly lending to the end borrowers. They're lending to the non-bank lenders, who then lend to the final customers. This creates a layer of separation that makes it harder for banks to spot fraud. And fraud is everywhere in this sector. The NDFI market has grown to $114 trillion and is growing 26% annually. That's insane growth. But with rapid growth comes risk. Here's a real example. Zions Bank, a major regional bank, just wrote off $60 million from a single NDFI relationship. They lent money to a non-bank lender who made fraudulent loans. The underlying collateral didn't exist or was massively overvalued. Western Alliance Bank, another large regional, was recently sued by a borrower who claims they were defrauded by the same non-bank lender that burned Zions. Same company, same fraud pattern. There's an old saying in banking, if you see one cockroach, there are hundreds more hiding behind the walls. The fact that 2 major regional banks got burned by NDFI fraud means there are probably dozens or hundreds of other banks with similar exposure. And here's the scary part. Banks don't have to disclose their NDFI exposure in detail. It's buried in their loan portfolios. You can't easily see which banks are lending heavily to non-bank lenders and which ones aren't. Industry insiders say NDFI fraud is an epidemic waiting to be discovered. Many of the loans were made in 2020–2022 when money was cheap and due diligence was lax. Now, as loans mature and need to be refinanced, banks are discovering the collateral doesn't exist or isn't worth what was claimed. Appraisals are being investigated for fraud, borrower income statements were fabricated, property valuations were inflated, and the banks that lent money to the non-bank lenders are left holding the bag. This is exactly what happened with subprime mortgages in 2006–2007. Banks thought they were making safe loans to mortgage companies, but the mortgage companies were making fraudulent loans to homeowners. When the fraud was exposed, the whole system collapsed. We're seeing the same pattern with NDFI loans right now. The warning signs are identical. Columbia Business School released a study showing that 44% of office loans are in negative equity, meaning the property is worth less than the loan. and 14% of all commercial real estate loans are underwater. When banks start foreclosing on these properties and putting them on the market, values will fall even further. That creates a downward spiral. Lower values mean more loans go underwater. More underwater loans mean more foreclosures. More foreclosures mean lower values. And NDFI loans, because they're less regulated and more prone to fraud, will be hit the hardest. So, which specific bank should you be worried about? Here's the critical information you need to check if your bank is on the danger list, and it comes from academic research that identified the exact threshold for bank failure risk. It's the CRE-to-capital ratio. And if your bank exceeds 300%, you need to move your money immediately. Let me break this down. The Florida Atlantic University study analyzed thousands of banks and identified the warning signs that predict failure. The single most important metric? How much commercial real estate lending the bank has done relative to its capital. Capital is the bank's cushion, the money that can absorb losses. If a bank has $1 billion in capital and they have $3 billion in commercial real estate loans, 300% ratio, just a 15 to 20% loss rate on those loans wipes out all the capital. And we're seeing loss rates higher than 20% in many markets. So how do you check your bank? You need to look at their financial statements, specifically the commercial real estate concentration, but most people don't know how to read bank financial statements. Here's the easier way. Avoid regional banks with heavy exposure to these markets. Office buildings in San Francisco, New York, Chicago, highest vacancy rates. Retail properties in declining malls, hotels in cities that lost convention business, apartment buildings in cities with population. Decline the banks most at risk are regional banks headquartered in or heavily lending to these markets. New York Community Bank is the poster child. They have massive exposure to New York multifamily and office properties. When values dropped, their loan portfolio went underwater. That's why they got downgraded to junk. But NYCB isn't alone. There are hundreds of regional banks with similar profiles: PacWest, Western Alliance, First Horizon, Zions. All of these regional banks have significant CRE exposure. Some are managing it well, others are not. The problem is, you won't know which ones are in trouble until they announce losses. By then it's too late. Deposits flee, stock crashes, and the FDIC steps in. Look at what happened with Silicon Valley Bank. On Wednesday, they said everything was fine. On Thursday, they announced a loss and tried to raise capital. By Friday morning, there was a bank run. By Friday afternoon, regulators shut them down. It happened in 48 hours. Customers had no warning. And SVB wasn't even a commercial real estate story. That was a different problem with Treasury bonds. Imagine how fast a bank fails when the underlying loans are completely worthless. Barry Sternlicht's prediction of 501,000 bank failures isn't crazy when you understand the math. If 300 plus banks have CRE ratios over 3% and CRE values drop 30-40%, hundreds of banks become insolvent. The FDIC doesn't have enough staff or resources to handle that many failures at once. It will be chaos. So you need to act now before the panic starts. But even if you think FDIC insurance will protect you, there's something critical you need to understand. Here's the harsh reality about FDIC insurance that most people don't understand until it's too late. It's that FDIC only covers $250,000 per depositor, per bank, per account type. And even then, getting your money back can take weeks or months. Let me explain what this means in practice. First, the $250,000 limit. If you have $300,000 in a checking account and your bank fails, you get $250,000 back. The other $50,000, you become an unsecured creditor. You wait in line with other creditors, hoping to recover something when the bank's assets are liquidated. Most people get pennies on the dollar. This is exactly what happened with Silicon Valley Bank. The bank had $175 billion in deposits, but only $4.8 billion, less than 3%, was FDIC insured. The rest was uninsured deposits from businesses and wealthy individuals. When SVB collapsed, those depositors panicked. They thought they'd lose everything over $250,000. The government eventually stepped in and made all depositors whole, but that was a special intervention. The FDIC is not required to cover uninsured deposits, and they probably won't do that for hundreds of small bank failures. Second, even for insured deposits under $250,000, access to your money isn't immediate. When a bank fails on Friday, the FDIC typically reopens it as a new bank or transfers accounts to another bank by Monday. But it can take weeks to get new debit cards, new checks, new online banking access. During that time, you can't pay your mortgage, can't pay rent, can't buy groceries if you don't have cash. Your automatic bill payments bounce. It's a nightmare. Third, if you have multiple accounts at the same bank, they might not all be separately insured. A checking account and savings account in your name? That's one $250,000 limit total, not $250,000 per account. You can increase coverage by having joint accounts, trust accounts, retirement accounts. These each get separate $250,000 limits, but you need to structure it correctly, and most people don't. The FDIC has an insurance calculator on their website, but it's complex. Most customers have no idea if they're fully covered. And here's the scariest part. The FDIC's Deposit Insurance Fund has about $128 billion to cover failures. That sounds like a lot until you realize there are $18 trillion in deposits in the U.S. banking system. The insurance fund is less than 1% of total deposits. If we get 500, 1,000 bank failures like Barry Sternlicht predicts, the FDIC fund will be depleted. They can borrow from the Treasury, but that takes time. Meanwhile, depositors are stuck waiting. The government always says your deposits are safe, but in reality there are limits, delays, and uncertainties. The only way to truly protect yourself is to not rely on FDIC insurance in the first place. So what should you actually do right now? Here's exactly what you need to do today to protect your money before the next wave of bank failures hits. Step 1. Check your bank's CRE exposure. Go to your bank's website and find their latest quarterly earnings report. Look for commercial real estate loans as a percentage of total loans or as a percentage of capital. If it's over 300% capital or over 30% of total loans, that's a red flag. You can also Google bank name, commercial real estate exposure, and often find news articles or analyst reports. Step 2. Move to big banks. I know people hate big banks, but JP Morgan, Bank of America, Wells Fargo, and Citi are too big to fail. The government will bail them out before letting them collapse. Regional banks? Not so much. Move your primary checking and savings to a big bank. Yes, they have worse customer service. Yes, they have fees. But your money is safer. Step 3. Spread money across multiple banks. Don't keep more than $250,000 in any single bank. If you have more than that, open accounts at multiple institutions. This way, you're fully FDIC insured everywhere. Step 4. Keep cash accessible. Have 3 to 6 months of expenses in a money market fund or high-yield savings account that isn't at a risky bank. If your primary bank fails and you can't access money for 2 weeks, you need backup funds. Step 5. Watch the warning signs. If you see news that your bank's stock is dropping or they're reporting losses or they get a credit rating downgrade, don't wait. Move your money immediately. Bank runs happen fast. By the time everyone else panics, it's too late. Step 6. Avoid these red flag banks. Any regional bank with heavy office building exposure in major cities. CRE loans over 300% of capital recent losses or credit downgrades, stock price down 30% plus in the last year. Headquarters in markets with declining real estate values. I can't name specific banks in this video for legal reasons, but you can research this yourself using the criteria I just gave you. Step 7. Business owners split payroll. If you're a business owner with large balances for payroll, split them across multiple banks. Use separate banks for operating accounts and payroll accounts. This way, if one bank fails, you can still make payroll from the other. The bottom line, don't trust that everything will be fine. We're in a banking crisis that's hidden beneath the surface. Smart money is moving now, before the panic starts. So we've covered the 5 critical threats to your money in the current banking crisis. The commercial real estate time bomb with $957 billion maturing in 2025 and special servicing rates at 25-year highs. The NDFI loan fraud epidemic that's growing 26% annually with $114 trillion in exposure, which banks are at highest risk with CRE-to-capital ratios over 300. Why FDIC insurance won't save you when it matters most, and exactly what you need to do right now to move your money before the failures begin. These are the warning signs that informed depositors are acting on while everyone else assumes their bank is safe. But here's something I didn't tell you at the start of this video. Everything I just shared is completely useless if you don't know which banks are actually the safest places to move your money to. Without knowing where to put your deposits, you could jump from one risky bank to another. Comment under this video, and I will reveal the 5 safest banks in America based on capital ratios, diversification, and stress test results. I'll see you in the next one.